Hi, everybody, and welcome back to Chapter 6 in our first video. And today it's going to include cash and receivables. Okay, and our learning objectives include how to report cash, define receivables, explain accounting issues, uh, look at accounting issues related to how we value accounts receivable, explain some of the other accounting issues related to recognition and valuation of notes receivable, and explain additional accounting issues related to both accounts and notes receivable. So, as we preview Chapter 6, first, cash. We're going to look at reporting cash, then the summary of cash related items, and then receivables, how we recognize them, measure them, and in some cases have variable consideration. As with our other videos, some of this will be review from our 1A or 101 courses, as the case may be, but I think you'll find that we've added some content as well. Okay, so how do we value accounts receivable? We'll take a look at the direct write-off method, the allowance method, and then how we do notes receivable, how we recognize them, how we value them. Other issues include disposing of receivables and presenting, and our decision analysis of those presentations. Okay, let's get started. Indicate how to report cash and related items. Here, cash, as you know, is the most liquid of our assets. It's our standard medium of exchange. It's the basis for measuring and accounting for all items. It is a current asset. Examples include coin, currency, available funds on deposit at the bank, money orders, certified checks, etc. Cash equivalents are short-term, highly liquid investments that are both readily convertible to cash and so near their maturity that they present an insignificant risk of changes in value. Some of those include treasury bills, certificates of deposit, commercial paper, and money market funds. Normally, I will invest for about a month because I can't predict it that accurately after a month, but cash equivalents academic definition is up to 3 months. Okay, reporting cash. Restricted cash. When material in amount, we're going to segregate restricted cash from regular cash. Sometimes we put money aside for planned expansions, retiring long-term debt, or maybe even a contractual agreement with a bank. So as it's shown here for Apple, they show some of those restrictions here. All right. Compensating balance. This is another type of restricted cash, and it's called a compensating balance. A compensating balance is a minimum balance that must be maintained in a bank account, which is used to offset the cost incurred by the bank to set up a loan. Compensating balances against short-term borrowings should be reported as current assets and as cash and cash equivalents. Compensating balance against long-term borrowing should be reported as non-current assets in either the investments or other asset sections using a caption such as cash on deposit maintained as a compensating balance. All right, let's take a look at an example here for Safeway. You are interested in purchasing a franchise from Subway, not Safeway, and need to borrow $200,000 for 1 year. Your bank agrees to loan you his money, provided you pay interest at 6% on the loan. In addition, the bank requires that you keep $20,000 as compensating balance related to your loan. Why do you think the bank requires a compensating balance? Well, the bank requires that for two reasons. One, in case of collection problems, the bank has $20,000 of your money. Or two, to cover loan servicing costs. The bank is effectively charging you more than 6% as you're paying 12%, $12,000, 6% of 200,000 for a loan of $180,000, not 200,000, which equates to an interest rate of 6.7%. 12,000 divided by 180,000. Okay, bank overdrafts. The company writes a check for more than the amount it has in its cash account. Not good. Reported as a current liability as part of accounts payable. Ooh. If material, we're going to disclose that separately on the balance sheet or in a related note. We offset that against other cash accounts only when the accounts are with the same bank. Okay, so cash, our classification, of course, is cash. Petty cash is cash. Short-term paper, cash equivalents. Short-term paper can be investments if the maturity is greater than 3 months and less than 12 months. And then post-dated checks or IOUs are receivables if they're assumed to be collectible. Travel advances, same kind of thing, assumed to be collected from the employee or deducted from their salaries. Postage on hand is a prepaid expense. It may be classified as office supplies inventory, but I think prepaid expenses is better. Bank overdrafts, that's going to be current liability, as the last slide indicated. And if the right to offset exists, we would reduce cash from the same bank. Compensating balances, this is cash separately classified as a deposit maintained as a compensating balance. And depending on whether it's current or non-current on the balance sheet, we would classify it that way or disclose separately in notes detailing the arrangement. Okay, let's put it into practice. Here, Atwood has the following items related to its balance sheet at December 31, 2025. Cash, money market and funds with cash, check cashing privileges, petty cash and payroll funds, short-term treasury bills with maturity of less than 3 months, post-dated checks, travel advances, postage on hand, cash restricted for future purchase of land, bank overdrafts, and compensating balances. How would you classify each of those? Let's take a look. Here are cash and money market funds with check cashing privileges. We're going to record that as cash. Petty cash and payroll funds, we're going to record that as cash. Short-term treasury bills, we're going to report that if it's less than 3 months. We're going to record that as a cash equivalent. And then our post-dated checks, that's going to be a receivable. Travel advances to employees, that's going to be a receivable if collected from the employees or deducted from their salaries. Otherwise, we're going to classify it as a prepaid expense. Okay. Here, postage on hand as stamps and a postage meter, we're going to record that as a office supplies inventory or as prepaid expense, either one. And then cash restricted for future purchase of land, we're going to report that as a non-current asset. And then in number 8, will report as a current will report bank overdrafts as a current liability unless the right of offset is permitted, and if the right of offset does occur, we'll deduct it from cash. And lastly, we're going to report compensating balances as a non-current asset, often as an investment. So, as we move on, let's define receivables and explain accounting issues related to their recognition. Here, receivables are claims against customers or others for money, goods, or services. They're classified in the balance sheet, either current or non-current, depending on how fast we're going to receive those. And we call those trade or non-trade. And here we have accounts receivable as trade and notes receivable as normally non-trade. All right, non-trade receivables. Here, advances to officers and employees, advances to subsidiaries, deposits paid to cover potential damages or losses, deposits paid as a guarantee of performance or payment, dividends or interest receivable, and claims against insurance companies for casualties sustained for tax refunds or for damaged or lost goods. All right. Now, receivables on the balance sheet, we're going to present those as shown here. Molson Coors Brewing Company. Here's their receivables and how they're reporting those. They're reported, of course, after the allowance for doubtful accounts has been deducted. And the same thing over here for Seaboard Corporation. We have trade receivables, receivables due from foreign affiliates, some other, and allowance for doubtful accounts as a subtraction. Okay. Now, how do we recognize these? Accounts receivable generally arise as part of a revenue arrangement. The revenue recognition principle indicates that a company should recognize revenue when it satisfies its performance obligation by transferring the good or the service to the customer. It's earned that revenue at that point in time. The revenue recognition principle means that we should recognize that once it's earned. So, Lululemon here sells a yoga outfit to Jennifer Burian for $100 on account. The yoga outfit is transferred when Jennifer obtains control of the outfit. When this change in control occurs, Lululemon should recognize an accounts receivable along with the sales revenue, and it's going to make the following entry. Debit to accounts receivable, credit to sales revenue for $100. Now that ignores the cost of that product, which should be done at the same time. So Lululemon has the right to payment from the customer. Lululemon has passed legal title to the customer. Lululemon has transferred physical possession of the goods. Lululemon no longer has significant risks and rewards of ownership of the goods. And lastly, the customer, Jennifer, has accepted the asset. Okay. Measurement of the transaction price is the amount of consideration that the company expects to receive from a customer in exchange for transferring goods or services. So in some cases, the price of the good or service is dependent on future events. These future events include discounts, return allowances, rebates, and other performance bonuses. Okay, that looks like a good place to end this video. And when we return, we'll take a look at variable consideration and trade discounts. Until that time, bye for now.